Okay, hi everybody. Welcome to the sixth session of our class for beginners, personal finance from mystery to mastery. Um, and just a little bit of preliminaries before we kick off with today's materials. So, as discussed last time in our video on real estate, we are really thrilled we're getting some member feedback now on sessions. So that was the first session we did that was directly responding to a member's request. And we've now actually gotten some other ideas that have been suggested by members, which we're going to tackle now for our advanced sessions. So we have a lot of good stuff in the pipeline for everybody. And so next week we will probably do a session on call options and how you can design a strategy to utilize call options to collect good fee income. So we'll analyze that together next time. In any case, let's get down to business here on our beginners session. So I'm happy to announce to you all that this is our last session on investing for the beginner class. And so we've almost completed another pillar, and then we'll move on to borrowing. So we've made brisk progress. In case anyone's missed any videos and want to review prior videos, they're all available on our YouTube channel. Anita will send a link around for that in case you don't have it. And with that, let's get started. Okay, so let's quickly recap what we did last session. So last session, I walked you through a very simplistic framework to kind of demonstrate to you how easy investing can be. I think one of the mistakes that a lot of investors make, not just beginning investors, but advanced investors also, we overly complicate our lives. And the truth of investing well is that generally the simpler, the better works, because if something's complicated, it's very hard for us to understand. So we walked through a hypothetical member, how we could design a very simple but effective investing strategy for that member. And we did that together. And then we reviewed a few core principles of good investing. So, diversification being one of the most important ones. And then we created that strategy for the member. So in this session, we're going to focus a lot more on some slightly more advanced topics around active versus passive investing and what the differences are for the two strategies, and how you can determine where on the spectrum you fall and what the right strategy is for you. And then we're going to put all our advice together on investing together in one neat little package so we can give the final takeaways, including do's and don'ts. And then I'm just going to preview where we're going in our next class on borrowing. Okay, so let's start with passive versus active investing. So passive and active investing, first of all, what does this mean really? So as the name suggests, passive investing means sort of not doing a tremendous amount of work in investing. You're letting the investing take care of itself. Active investing, on the other hand, as the name suggests, requires a lot of work and effort to do very well. So I'll just walk you through some of the core differences, right? So let's start with passive. So when we're doing passive investing, we're not making specific bets, but we're investing in a very broad asset class. So to explain this very intuitively, it's the difference between, say, investing in a single stock versus the entire Nifty index, right? If you're investing in a specific stock, you're going to be making a specific bet on how that stock does. If you're investing in the Nifty 50 index, you're investing in all the 50 stocks that make up that index. So you're basically investing in a slice of the economy. So passive investing tends to be very easy to do. You don't need to do much analysis when you're doing passive investing because you're not going to need to analyze any specific stocks because you're diversified. And the returns will match the overall returns of the asset class. So if the asset class does well, you'll do well. If the asset class does badly, you'll also do badly. And the risks you're taking are confined to the overall risks of the market and the asset class. So, for example, as we've seen in the COVID crisis, even when you're doing passive investing, you can have significant losses in the short run, right? So the market's corrected very severely, but you're guaranteed when you're doing passive investing to do in line with the market. On the active side, though, you're making specific bets based on your research and views. It's very difficult to do this well, right? And returns will reflect the quality of your individual bets, not just how the market does. You can have scenarios where you're doing active investing, where even when the market has done very well, if you've made the wrong bets, you could still do very poorly. Or the converse, where if the market has done very badly, if you've made the right bets, you can still do very well. And the risks you're taking here are not just market risks, but also specific risks around the companies that you're picking to invest in. So what are the punchlines? Like, what kind of results can you expect with these two strategies? So in general, passive investing, as we covered before, tends to beat active investing on average. Now, this on average is a very important point, right? So that means if you are not overly confident of your ability to pick trends and forecast the future and all, passive is probably a good strategy for you. Active, on the other hand, you can do extraordinarily well if you have a talent for picking the right bets to make, and over long periods of time, even earning a little bit more than the index can create tons of wealth for you, extra wealth for you. So now let's see what the kind of investment strategies are and how they fall along the passive to active spectrum. So the most passive style of investing is investing simply in an index fund. As we discussed, that's investing in a broad basket of stocks that track a particular index. You can't get more diversified than that. You're guaranteed to do as well as the index does. The next is investing in a diversified fund. So this is a fund that may take some specific bets, but they're not going to take very large bets on particular industries or companies. So you may beat the index by a little bit, but you probably won't deviate too much in your return from the index. So it's a little bit more active than a passive, than the index fund. Then as you move up the spectrum, you can pick a focused and thematic fund. So maybe you want a fund that's focused on the BFSI sector or FMCG sector. So you can look for funds that specialize in those sectors. They're obviously taking specific bets in the industry. And the most active strategy that you can pursue is picking your own individual stock investments, which is the most active because you're calling the shots to a very granular degree. So the key question when trying to figure out how active or passive an investment is asking yourself the question, how much am I betting on the overall market and how much am I betting on specific ideas or themes? And that's going to tell you where on the spectrum your investment lies. So where do you belong on the spectrum, right? So this is a very, very important slide in my opinion, because a lot of people make mistakes on where they fall in the spectrum. And the key to doing investing well and finding the right place you belong is being honest about the level of work you're willing to do on your investing portfolio. One of the biggest mistakes I see people make is going into active strategies without doing their homework and research. So let's talk a little bit about what kind of work is involved in each of these strategies. So with an index fund, you don't really need to think much about this. You just need to think about carefully how much money you're putting into the market and how is that the right amount of money given your personal circumstances. You don't really need to do much due diligence other than maybe check the market PEs, etc. So it's a pretty autopilot strategy and designed for people that are busy, that don't really want to think about it and that are satisfied with market returns. The next strategy of diversified fund, right, is one where you don't want to do too much work. You trust a manager or an AMC or a PMS that's broadly diversified. You trust the manager to do a good job, and you hope that this manager is going to do a little bit better than the market, right? And that's kind of the right sweet spot for someone to invest in a diversified fund. They're really trusting the manager to do a good job. What about focused and thematic funds? I think this strategy is suited for people that have done their own homework and their own thinking around what sectors they think are going to do well in the future. So let me give you an example. Let's say that you're working in the FMCG sector and you saw what was going on with COVID, right? And you saw your company was doing very well, selling more of its products, and you realized that the FMCG sector may really do well out of this whole dislocation that we're seeing because more people are going to eat at home, right? So in this scenario, you may have said, you know, I've done my homework, I know the space very well. I don't want to go and pick individual stocks in the FMCG sector, but I know I want to invest in an FMCG oriented fund. Then you could go find a fund that matched that strategy. So this is the right strategy for someone that's done their own homework and has their own views. And it's going to allow you to generate stronger than market returns if your analysis is correct. And then the most active strategy is for people that have a lot of time on their hands to do deep due diligence on individual stocks. So if you want to get a flavor of how much work is involved in doing due diligence on individual stocks, I recommend you look at our Stocks Zero to Hero series, where we actually analyze a stock together from scratch. That will give you a good sense of what kind of work is involved before making an investment decision in stocks. And for members, you can also see our research notes on some stocks that we've analyzed for our own fund. And doing individual stocks promises very strong rewards if you do it right, but it's also very, very hard to do and fraught with risk. So you really need to have a good idea of the individual stocks you're buying. So one conclusion that I just want to draw out from these strategies is that you'll notice a very clear relationship between the work required and active strategies. So anytime you're coming down the spectrum towards active, you need to ask yourself the honest question of, have I done my homework? You can always get lucky in investing and, you know, things may work out, but you don't want to rely on luck in investing. You want to de-risk yourself as much as possible. And if you're moving towards active strategies, then it's really incumbent on you to properly think about the risks that you're going to be taking. So be very, very careful of that. So I'm actually going to give you a very personal case study of why doing homework is important. So this is one of my investing mistakes that I made earlier in my career. And hopefully you guys can learn from what I did wrong and hopefully take away the right lessons from it. So when I was working very long hours in a private equity fund in the US, I was thinking about what I wanted to do with my savings. And back then I said, look, I'm in the business of analyzing companies, so I'm going to invest in a stock, you know, why not? And I didn't have a lot of time to do deep research. I didn't have a lot of time to do deep thinking. I just looked at a few ratios. I felt like I knew the company at a high level. And I said, you know what, this company looks good. So the company I bought was Walmart. And I bought it thinking it was cheap. It was very defensive because the company owned a lot of its own real estate. It is one of the largest retailers in the world. And what could go wrong with investing in Walmart? So I invested at around this price here, around $78, $80 a share. Shortly thereafter, you can see the share price precipitously fell to approximately $50 a share, a little higher than $50 a share. Now that was a really scary thing for me to see, right? Because I just put money into the stock. I didn't have time to analyze the situation. I was working, 20 hours a day, during the week, and then even some weekends I'd be working. So, I didn't know how to react because I didn't do my homework on the stock. So at that point I said, chalo, I've taken such a big hit, might as well hold the stock. Again, no logic, no reasoning on this. And the stock price eventually recovered where I could get my money back. So I sold out to get my money back and quickly thank my lucky stars that I got my money back. Now, if you look what happened to the stock after I sold, it was a terrible decision to sell because the stock actually did very well. Now, why did I make these mistakes, right? Why did I get so scared when the stock price went down? Why did I not understand that the long-term prospects of the company were still good? It's because I didn't do the research or homework required to give myself conviction. Because I didn't do detailed homework and research and I didn't really know the company, when the share price went down, I was at the mercy of the market. I got panicky, I got scared, and at the quickest opportunity, I exited and I left a lot of money on the table, right? On the other hand, I'll give you another example of an investment where it's worked to my advantage, doing my research and homework. So recently, as some of you may know, we recommended a position in gold, and the price of gold actually ended up falling after the US posted better than expected job numbers. But I had done my homework. I still expected a lot of economic pain to come, and I expected a lot of stimulus requirements to fill the hole caused by COVID. And I had conviction this time. So when the price of gold fell after that jobs report, I bought more gold at a lower price. And because I had confidence and conviction and I knew the risks I was taking, I was able to profit from that irrational move down. So doing your research and homework when you're making active investments is super, super important. You do not want to be on the mercy, at the mercy of the market. You don't want stock prices to dictate to you whether you should buy or sell a stock. You want your research to dictate whether you should buy more or sell your stock. Otherwise, you're just going to be following the market and you might as well be doing a passive strategy. So some of you may be looking at this saying, you know what, active investing is not for me. I don't have the time to do it. I'm not interested in doing it. Market returns are good for me. And I think that's great. I think for 90% of people, passive investment strategies are perfect and you don't need to complicate your life. But I wanted to give a little bit of advice for people that want to move up the spectrum of becoming more active of an investor. So here's a little bit of things you can do to move up that spectrum. So how do we get investment ideas, active investors? The key here is to read. And the key here is to form your own conclusions. Don't read expert opinions and just follow them, but actually read with an eye of making your own primary conclusions based on primary data. So you may read an interesting article about, certain trends in millennial behavior, right? Millennials may be cooking more at home, right? If you read an article like that, you can ask yourself, well, what are the conclusions of this? If this trend is happening, what does that mean about future behavior and what sectors are going to do well, etc. That's kind of how you build your crystal ball for the future. And if you're into that kind of thing, thinking about the future and what may happen, then active investing is a good fit for you. The other super important thing is asking yourself what could go wrong with your views of the future to keep yourself honest. It's very easy to think you have a magic crystal ball that you're always right, but the truth of the matter is, right, even the best investors are right only 60% of the time. So another important thing is to ask yourself is what could go wrong? How could your thesis not come out to play? And the last tip I have is learn how to analyze stocks. So check out our Stock Zero to Hero sessions. And then there's some books that I recommend you read. The authors are listed here. So Peter Lynch has a great book on the basics of investing. Warren Buffett has a collection of essays that are excellent. Joel Greenblatt's book of how you can become a stock market genius is also a fantastic book. So Peter Lynch's book, by the way, is called One Up on Wall Street. So these are some classic investing books that can be a very good start on the path to becoming an active investor. As always, you can email us on advisory@Bharosa Club if you want further tips on how to make that transition. Okay, now that we've covered that passive versus active spectrum, let's get down to our final advice on investing. So how do we make sure we're investing well? The first and most important thing is to get your investing buckets right. So we covered this 2 sessions ago. So you can rewatch that video. But this is an often neglected part of investing that is super important. So you need to understand your life circumstances and personal preferences. And you should let those dictate how much you allocate to safe investments, how much you allocate to medium risk investments, and how much you allocate to growth investments. And getting that right is going to prevent you from having to do very financially damaging things like selling in a crash. You never want to sell in a crash if you can avoid it, right? Because you're selling at low prices. And if you manage your finances right, you will have the ability to hold through crashes in prices, right? So that's the goal of getting your buckets right. Make sure you've saved enough for a rainy day, and decide what allocation makes sense to you following the logic that we set out in the last couple of videos. The other thing that we really recommend is keep your safe buckets safe. Unfortunately, a lot of investors have learned this the hard way recently with the Franklin Templeton mutual fund debacle. Oftentimes we get greedy and we chase return, and we forget that there are no free lunches in the investing world. And usually when something gives you a higher return, there's also more risk. So always try to keep your safe investments really, really safe. We're recommending currently that your safe money be in overnight funds, or FDs are also okay. We prefer overnight funds because you're not locking in, there's no redemption penalties, etc. And don't get greedy with it. The goal of your safe money is not to grow your corpus. The goal of your safe money is to protect you. So for your safe money, keep it really, really safe. Find the right investments. So the first step on this is do an honest assessment of how much work you're going to put in. If you're not willing to truly understand a complicated investment, stay away from it. Look at only investments where you have an understanding of them. And if you don't have an understanding of any of these active investments, safest bet is to go passive and invest in the index. You can't go too wrong with investing in the index. You're going to track the performance of the overall market. We also covered a framework in part 4 of this series, which will help you decode any investment to see if it's right for you or not. We gave you the key parameters to consider. Review those parameters in that framework, and it'll help you figure out if an investment is appropriate for you or not. And again, to stress, just keep it simple. Keep it really, really simple. And then periodically reassess. People's circumstances change. And when your circumstances change, you need to update your buckets as well. Maybe you've had a kid and your expenses have gone up. Maybe you need more money in your safe bucket than you needed before. So you need to periodically reassess your investments. I recommend that you monitor the performance of your investments every month at a minimum. You can do it even more frequently if you like. Compare the return of that investment for the appropriate benchmark. If you're not sure what the appropriate benchmark is for the investment, ask the fund manager. They should, in their literature and performance reports, track to a particular benchmark and see how they're doing relative to that benchmark. Understand as best you can any big underperformance or outperformance. So for any investors in our small case, right, when we issue our performance reports every month, we show you how we did against the benchmark, and we tell you why we underperformed or why we outperformed. That's a very good habit for you to ask of your managers and look for in your managers, so that you understand the logic of why they're performing the way they're performing. Comprehensively reassess your portfolio every year to update it for changes that are more fundamental in your life, and rebalance them if required. Okay, now some traps to avoid. Trying to beat the market without doing homework. Absolutely, absolutely avoid this trap. If you're going to try to beat the market, make sure you do lots of homework. The other trap that I've seen a lot of, which I don't recommend, is investing through life insurance products. This is very common in the Indian market, not very common in the US market. And this is a very confusing way to invest um, because it's conflating two products together. You're buying a protection product and you're buying an investment product in one product. So it's very hard to understand how your investments are really performing because you have to strip away the impact of the protection that you're paying for. So we're not fans of this. It just makes it very complicated to understand how well your investment is performing. And it's also a very easy way for you to buy extra insurance that you actually don't need. So we recommend you just stay away from this. Use insurance to protect and use investment products to invest. We discussed chasing returns in your safe bucket. You shouldn't be doing that. Over fiddling with your portfolio. There's a lot of temptation to make lots of changes here and there. That's not a good strategy to pursue. It can have serious tax consequences. Favoring complex investment schemes. We should be doing the exact opposite. A lot of times we think, oh, this is such a complicated scheme. That's why it's giving me such good returns, right? Well, we should ask ourselves the question, this is such a complicated scheme. Do I understand all the risks that I'm getting into, right? So look for simplicity when you invest. Don't look for complexity unless you're super active and willing to devote lots of time to understand the risks. Okay, what are the investment do's? Maximize your tax efficiency by taking advantage of some tax advantage schemes. So there are a lot of these in India that you can take advantage of. I'm going to do a session on this at some point where we'll cover some of the more common ones and the better ones. But understanding how these can work to your benefit can give you a good edge in optimizing your portfolio. And diversify if you don't have a reason to be concentrated. It's okay to be concentrated. My portfolios are pretty concentrated in the US because I have a reason to be concentrated. I've done my research, I have a view, and I know the risks I'm taking, so I'm willing to be concentrated. But if you haven't done the work, then be diversified. Don't be overly exposed to any particular stock, any particular industry. Okay, so that's kind of it for investing. Our next pillar that we're going to cover is borrowing. And borrowing is, in my view, one of the most misunderstood pillars in personal finance. It is something that people are either irrationally scared of. A lot of people don't like borrowing even a rupee, and they underborrow. And there are many people that borrow too much and too riskily. So there are very few people that understand how to borrow well and how to use borrowing to your personal advantage. So we're going to explore how to do that and how to make borrowing work for you and not harm you as our next topic. So with that, I'll open it up for Q&A.
Okay, so there's one question post-COVID, digital is likely to do very well. Do you agree? And if yes, how could we find stocks that will take advantage of this trend, which we can analyze?
So very good question. It's almost immaterial if I agree with this. The key question that you should be asking yourself is, do you agree with this? But just because the person asked, I do agree with the logic. I mean, I think that if you look at what's happened in the world of COVID, there is a fundamental communication gap now that many businesses face in reaching the consumer. It used to be the case that when a consumer wanted to buy something, they could simply go to the store and pick it up, or send their driver to go pick it up, or ask the Kirana store to deliver it, or whatever, right? Now that's very challenging to do, right? So suddenly communication has become a lot harder for brick and mortar players with the customer. But that communication problem does not exist for digital players. So digital players are still able to reach their customer. They're still able to sell their products. There was a little bit of disruption in the peak of the lockdown where even digital players were having trouble fulfilling, like Amazon was not selling any products for a long time. But digital has definitely weathered the storm better than brick and mortar for the time being. The key question I would ask in terms of going forward is how long lasting of a behavioral change will this engender in the market? Do you think that because of this disruption, people are going to get hooked on buying digital and they're going to buy less in brick and mortar than they were before? The behavior is going to fundamentally change. If you think that, digital is a great sector to be long. If on the other hand, you think that brick and mortar has some advantages over digital, then then I think you may question how much of that behavior will permanently change, and that people may actually go back to buying from kirana stores and physical shops once things open. I happen to be in the camp of thinking that digital does have some advantages, but that they're pretty fully priced in right now. And I think people are not fully giving credit to brick and mortar players. There's a lot of advantages that brick and mortar has over digital that I don't think is fully appreciated in India. One example being simply the unit economics. I think it's cheaper to get goods to a customer in India physically than through digital fulfillment chain. When you take into account failed deliveries, return products, the logistical challenges and supply chain challenges of delivering in India. I've looked at the numbers and I tend to be a little bit more bearish on digital than consensus. What was the second part of the question? So one was, do you think that digital will outperform? Or how do you get exposure to?
So how do we find stocks that will take advantage of this trend?
So one is you can actively look yourself. So a good place to start would be InfoEdge, for example. InfoEdge is a digital company in India that's listed. It's a well-known one. And as you're reviewing a company like InfoEdge, it'll uncover other potential digital players that are smaller, etc. So start with the market leader. And if you're interested in the sector, read up on it, and your research will inevitably uncover other investment opportunities for you. You can also look for fund managers that agree with your thesis, that are long digital, and invest behind them if you want to take a more passive approach, but still think digital will do well.
Okay. There was one comment on, it's important to be understanding the momentum to be in and out of stocks.
Yes, momentum certainly can play a role in stock investing. I think we're seeing a lot of that right now. The markets have been ripping higher and a lot of momentum, and people that were on the sidelines are now getting into the market, propelling it higher and higher and higher. My general view on that is to stick with fundamentals. It's very hard to gauge where momentum is going to continue or whether it's going to abate. And you're kind of trading on emotion when you're trying to predict where the market's going to go in the short run. And that tends to be a little riskier and tougher to analyze, in my point of view. There are a lot of people that have done it very well. So at Bharosa, what we do is we use momentum to uncover good potential stocks to analyze. So I'll give you an example. We saw that Muthoot Finance was doing very well. And when I saw that on the momentum tracker, I said, okay, that makes a lot of sense because Muthoot is a gold loans player and gold prices are going up. So in a market where everyone's collateral value is going down, gold prices are actually going up. So that gives Muthoot an advantage as a lender. So then I did my work, fundamental research to uncover whether it was a good stock or not in my point of view, right? So I used momentum to identify a potential idea, but I didn't invest only because of the momentum. I did my homework and my research and all those things. But I agree with you. Momentum it can be a very helpful factor to identify good or bad stocks.
Also, in continuation with how do you identify the stocks? How do we find stocks related to the digital comment, the question? We could also look at stocks held by the thematic mutual fund or small case, right?
Absolutely. And one very simple way, you think digital is going to be a beneficiary in this whole thing. perhaps the easiest way to get exposure to digital is to buy the NASDAQ ETF, because the NASDAQ is heavily tilted towards technology and digital, right? So if you're bullish on digital, and by the way, you need to make sure that the price makes sense, because a lot of people are bullish on digital right now. So the prices have gone way up of these companies. But that's another way you can look at playing digital. But yes, I really like that idea as well.
Okay, there's a question. Would you call a sovereign gold bond investment as a passive investment?
So sovereign gold bond. So I have a view that's a little different here. I don't think of gold as an investment. Gold does not produce any earnings, right? When you buy gold, there's no cash flow that it generates. Gold is actually a hedge, in my view, a portfolio hedge. What does it hedge you against? It hedges you against inflation and currency debasement, right? So if you're worried about the government printing lots of rupees, or spending too much, or taking out on too much debt, and you're worried the rupee will weaken, or that we're going to have very rampant inflation and the value of the rupee is going to purchase less and less goods in the future, then gold is a good hedge, right? So I don't view it so much as an investment. The one exception is what you're talking about, which is the sovereign gold bond, which actually pays you a coupon. The coupon is very small in the sovereign gold bond. I think it's 2-3% or something like that. So again, I would tend to not think of it so much as an investment, but more as a hedge. I think it's a very smart idea for people to have some element of gold in their portfolio, not a very large element of gold, because it's not an investment, it's a hedge. The sovereign gold bond is a very interesting way to make the gold investment if you're willing to hold it for a long time, because the liquidity in that is not very high. So you have to hold it for 3, 4, 5 years or whatever to fully for it to make sense for you. But it's a very interesting structure, and I actually just learned about it. A member pointed it out, and then it came up in a conversation I was having with someone recently. So it seems like a very good structure if you're willing to hold gold for a long period of time.
Okay, I think there are no questions. So we can probably end this session.
Okay, that's okay, good. So I'm really happy that we finished another pillar, and look forward to covering borrowing with you guys. And join in next week for one of our advanced sessions if you're interested in learning about derivative strategies, specifically around call options. So look forward to doing that with you guys next week. Thanks, guys.